Hello, my dear students. Welcome to SDL Knowledge Hub channel. I'm your host, Shehan Dias. Today, we will be looking at double entry or dual impact of accounting.
Dual impact of business transactions. Due to transactions, the values of assets, liabilities, equity, income, and expenses change. So these are called the accounting elements. So because of the changes in the accounting equation, for each transaction there will be two entries that will affect these accounting elements. So this is termed as dual impact of a transaction. So due to the dual impact of a transaction, the value of each transaction should be written in two places. This means there should be two entries for each transaction. However, when a business expands, the number of transactions increases, and recording all of them in the accounting equation will not be practical. So therefore, these are recorded in a structure called an account. An account is a commonly accepted structure that is used to record the change, that is increase or decrease, in the accounting elements, that is asset, equity, liability, income, expenses. So the format for the account will be date, description, ledger folio, value, and having both debit and credit side. Double entry system. The accounting system which records the same amount in the debit and credit sides of an account is called the double entry system. So when recording the dual impact of a transaction, as per the double entry system, the same amount should be recorded in two separate accounts. Now each account has both debit and a credit side. If the value of a transaction is debited to a particular account, that same value should be credited to another account. Based on the accounting elements, there are five types of accounts. Those are asset accounts, liability accounts, equity accounts, income accounts, and expense accounts. So if you look at examples for each of these, asset accounts, building, debtors, cash, etc. Liability accounts, creditors, bank loan, etc. Equity accounts, capital account, then drawings. The income account, sales account, rent income, dividend income, etc. And expense accounts, salary, traveling, water, electricity, and likewise. The ledger. The ledger is the place of collection of all the accounts. Therefore, recording business transactions in accounts is also called as recording in the ledger, or we say ledger entries. Principles of double entry. The generally accepted principles in recording transactions in the ledger is called the principles of double entry. Since there are five types of accounts, there are five principles. These are as follows. Asset accounts, increase is debit, decrease is credit. Liability accounts, increase is credit, decrease is debit. Equity accounts, increase is credit, decrease is debit. Income accounts, increase is credit, decrease is debit. Expense accounts, increase is debit, decrease is credit. So as you can see, both asset accounts and expense accounts have similar recording, whereas liability, equity, and income accounts has similar recording where increase is credit and decrease is debit. We will now look at how the double entry principles are applied for different types of accounts. So you are given 10 accounts, so need to look each type of account, the each account, which type of account and how it is recorded. So if you take the first one, building account is an asset, so therefore increase is debit, decrease is credit. Bank loan account is a liability account, therefore increase is credit, decrease is debit. Sales account is an income account, so increase is credit, decrease is debit according to the double entry principles. Electricity charges is an expense account, increase is debit, decrease is credit. Interest received account is an income account, so therefore increase is credit, decrease is debit according to the double entry principles. Vehicle account is an asset account, therefore increase is debit, decrease is credit. Purchase account is an expense account, therefore increase is debit and decrease is a credit. Capital account is an equity account, so increase is credit, decrease is debit. Then drawings account is also an equity account, but it is called a negative equity because in normal sense equity increases will be credit, decrease will be debit. But drawings being a negative equity account will be the other way around. Increase will be debit and decrease will be credit. So you should keep in mind drawings are treated differently even though it's under equity but it's negative equity. The debtors account is an asset account. Increase is debit, decrease is credit. Now we will look how transactions are recorded in accounts. First one, the owner invested 500,000 as capital on 5th January. So owner invested 500,000 cash. So cash is an asset, increases, so debit 500,000. Capital is equity, so increase, credit 500,000. So cash account need to debit stating description as capital, and capital account needs to credited stating cash for 500,000. Next transaction is purchased machinery on credit from Silva for 75,000. Therefore, asset machinery increase based on double entry principle, debit machinery account 75,000 and credit Silva's account for 75,000 because liabilities increase. Then third transaction, obtain a bank loan for 200,000. So cash asset increase by 200,000 debit and bank loan liability increase 200,000 credit based on the double entry principle. So need to draw the bank loan account and credit it for 200,000 and also debit cash account for 200,000. The fourth transaction, sales made on cash for 75,000 on 14/1/21. So cash asset account increases, so debit for 75,000 and sales income account increases 75,000, so credit for 75,000. The next transaction, sales made on credit to Smith for 50,000. So Smith is a debtor who has bought things on credit basis. So debtors is an asset increase, so Smith's account, therefore, debit for 50,000. And sales increase credit for 50,000. Next transaction is paid salaries for 100,000. So salaries is an expense. So expenses increases means debit for 100,000. Then cash asset decrease, therefore credit for 100,000. So salaries account 100,000 debit and cash account 100,000 credit. Received rent income for 50,000. So rent income is an income account. So increase in income is credit based on double entry principle. And cash also increases by 50,000. So asset increases is a debit based on double entry principle. So rent income account credit for 50,000 and cash account debit for 50,000. Finally, the last transaction, owner withdrew money from the business for 25,000. So drawings is part of equity, but as we discussed earlier, this is negative equity. So if equity increases, it will be credited, but negative equity increases will be debited. So drawings account debit 25,000 and cash and asset account decreases. So cash account credit for 25,000.
Hope you got valuable knowledge from this video. If you haven't subscribed us yet, please subscribe. So until such time, till we meet again with another similar video, goodbye for now.